Hello and welcome to the latest Colliers Global Capital Markets webinar. I'm Chris Pilgrim, Managing Director of Colliers Global Capital Markets business for Asia Pacific, and I'm based here in Singapore. I'm delighted you're able to join us for what looks to be a fantastic session discussing Asia Pacific, a global capital magnet in 2024. Commercial real estate is emerging from a challenging couple of years, and we now see some sectors and geographies at the start of the next upward cycle. Confidence is returning to investors in both deploying capital and also belief that some economic headwinds have stabilized or are now factored in to risk-adjusted returns. We have seen a significant allocation to opportunistic, value-add and core plus strategies, both in this region and also from capital in Asia Pacific, targeting US and European markets. But since the start of this year, we see from our clients a significant rise in investors returning to core assets, reflecting the market reset. This demonstrates confidence returning to many markets and sectors. In Asia Pacific, we benefit from sitting in a region which also benefits from significant capital investing from within the region, but also increasingly from externally too. For this year, Japan and China sit in the top 10 global markets for receiving overseas capital, whilst Hong Kong, Singapore and Australia remain major economic hubs. We continue to see more capital allocations to South Korea and India, further enhancing the diversity of this region and investor appetite. Asia Pacific countries remain dominant capital sources for moving inter-region and targeting assets in the top 10 markets for cross-border capital, including the US, UK and European markets. With this in mind, I'm delighted to introduce the agenda and my colleagues from around the world joining us today. Damien Harrington is based in London and is Head of Global Capital Markets Research, who will provide a relative overview of the global regions. Joe Henderson heads up Australian research, but has a broad view of the Asia Pacific region and will be deep diving into these markets. After which, we will be putting your strategies to the test with a short interactive polling session prior to a panel discussion. Joining Damien, Joe and myself on the panel are our market and cross-border capital experts, Thomas Chack, Head of Capital Markets in Hong Kong, Lucy Malik, based here with me in Singapore and leading Asia Pacific capital being deployed into the Australian markets, and Hazumu Iwasi, Executive Director and based in Colliers' Tokyo office and heads outbound Japanese capital. For the panel discussion, the final point from me is that you will see on your screens there is a function to ask questions throughout today's session. So please do participate and we will look to address as many of these as possible. With all that in mind, I think we're in line for a great hour ahead. And now over to you, Damien.
Thanks, Chris. So look, as Chris has said, the markets are moving. Certainly kind of underneath the markets, there's a lot more traction and activity, but it is a very complex marketplace. And whilst things like inflation and GDP are coming to a more sort of sustainable level or a clearer level in terms of what's coming next and what's going to happen next with interest rates, which certainly look like the peaked bar one obvious market. Pricing itself looks like it's relatively normalized, but there's been changes to the capital stack as a result of all these changes, certainly in Europe where we've got ESG that's having an influence on CapEx and OpEx, and that continues to change investors' capital stack across assets and portfolios. On the other side of the coin, as it were, there's still in some cases quite a lot of corporate debt. So for the occupier, there's quite a few decisions to make in the next few years is how they run their business and their operations, and that may well influence their behavior further ahead. And of course, all of this influences FX and Forex and fundraising and capital flows. So without further ado, let's just do a quick run through what we're seeing in terms of capital flows inbound and outbound across the global regions and the countries that are seeing more interest than others and the sectors that are benefiting more than others. Okay, so this chart or set of charts shows investment volumes per global region over the 10-year average, which is the grey bars. So at the bottom is the kind of minimum level of the range within a particular month. The top is obviously the highest level of volumes that's been seen within a particular region within that month over the last 10 years. So the dark blue line and the dots represent what happened in 2023. And what we can see is that in pretty much every region for every month, bar one, investment volumes were at the bottom of the range. I mean, we know 2023 was a weak year, but it was still about 75% of the 10-year average. I think what's interesting is if we look at 2024, we're still at a fairly subdued level of investment volumes. We know deal flow is picking up, but volumes are naturally lower anyway because values are lower. And I think what we saw in December in APAC, which was essentially an awful lot of land deals and development side transactions, was a bit of a one-off, a bit of an anomaly, and everywhere has reverted to type. But hopefully we'll see things picking up in Q2, certainly Q3. Now, if we look at investment by sector, industrial was the leading sector globally, which was certainly what was anticipated and came through in the results of our Global Investor Outlook survey. But interestingly, whilst it's number one globally, it's not number one in each region. And I think, again, we're seeing a bit more diversification in terms of activity across the three major global regions. So, APAC has been led by offices, then by industrial, and then a very big chunk towards retail. North America is led by multifamily, then industrial, then retail, then office. EMEA is just led by office, but the distribution of spending across all asset types in EMEA is actually pretty even compared to the other two regions. And there's been a significant chunk of spending that's gone into hotel. So we are seeing activity across all asset types, which is healthy. It's good for the market, and it shows certainly that the office market is anything but dead, particularly in APAC where it's strong. Now, if we look at the key destinations for cross-border capital, in some respects, not too many changes, certainly at the top of the leaderboard. UK was top at the end of Q4. It has expanded its reach, as it were, so more money moving into the UK market, which has repriced pretty consistently across the board, and it maintains its position as a strong global magnet for global capital. US is in second place. Clearly, the size of the market is a big factor. Then you've got China, then you've got Japan, and then all the other markets are actually European. So some of the APAC markets that were in last time, Australia, I think Japan had made it, Japan is still here, have dropped out of the top 10. And I think that's partially down to some of the opportunities that our investors are seeing across Europe as it reprices, and we're starting to see some signs of distress come through. Now, that was for standing assets. It's a different picture for land and development sites, and this is where the APAC region really stands out. 4 of the top 5 markets globally are all in APAC: China, Singapore, Australia, and India. 6 or 5 of the top 10, you've got Malaysia in there as well. So as an emerging still economy and a strong growth economic economy, there's an awful lot of demand for new development as the market continues to scale up on a per capita basis. So APAC certainly leads in that land and development sphere of investment. Now let's get on to the sort of nitty-gritty of what's driven markets considerably over the last 2 years: inflation and interest rates. So the chart here shows that on the left-hand side where inflation is for major global economies, split by region. The dark purple box shows where inflation was at the start of this whole process back in Q1 2022. The outline part of the bar represents where inflation was at the end of last year. The filled out part represents where inflation is as of April. So if most policymakers want to get back to this target range of about 2%, between 2 and 3%, most markets are just about there. Some are slightly outside it, some remain slightly inside it. But we've also seen since at the end of last year, inflation where it had dropped down has started to creep back up. So it still keeps moving. And certainly from all the noises we've heard from policymakers in the last 2 or 3 months, particularly also in the last couple of weeks, there's still no confidence that core inflation is quite at that sustainable level, but we are much, much closer to hitting that target rate. I think Bank of England last week voted to keep interest rates on hold. The Fed had made noises, I think, the week before to say that, again, they were keeping rates on hold. And I think most markets have taken the same position, but we did see the first sign last week in Sweden that interest rates would be cut by 25 basis points. We also heard the same in Switzerland. So the Swiss central bank is cutting interest rates. And it's not necessarily to do with inflation, which is still quite strong, but it's more about the economic growth of the GDP forecasts for this year and next. And certainly when you look at EMEA or Europe relative to APAC and North America, the GDP or economic position remains pretty weak. So I think as a result of that, we will see rates moving out faster, but in Europe, relative to everywhere else, certainly across the Eurozone, there's a decision coming up on the 6th of June, and I think we will see the first rate cut across the Eurozone, and I think we'll see subsequent rate cuts thereafter, maybe another 2 by the end of the year, which will take 75 basis points off the ECB interest rate. In APAC, growth is still relatively strong, and if we look at some of the decisions or outlooks for cuts in interest rates, there will be some this year, but it's relatively mild. In North America, the jury remains out. GDP growth is really strong. Inflation is still pretty strong. The GDP forecast for this year continues to increase. So despite where interest rates are, despite the fact that the market was pricing in big interest rate cuts this year, we may not see any interest rate cuts in North America this year, or they may only happen at the very end of the year. And that's almost the reverse of what would normally happen. So if we think of this in terms of spreads of yields to interest rates on an all sector basis across all regions, APAC has obviously maintained a very healthy interest rate spread over time, and that spread will marginally increase. It also points to potential for some yield compression a little bit later, but some marginal cuts in interest rates in APAC, which will make the spread look a lot better. Depending on what happens in North America, this current spread is very tight, and that may well remain tight over the course of this year. Whereas for EMEA, if we get this 75 basis point cut, maybe 50 basis points in the UK, that spread will start to widen, and it's starting to make Europe a lot more attractive as a destination for capital. The other flip side of what happens with interest rates or the FX is the spending power of that currency, as it were, relative to other currencies. Now, this is a fairly complex part with lots of different currencies to currencies on it, but what I'm just trying to show here is a fairly simple message. Relative to the US, all of the currencies, in terms of a hedging basis, if they look at that currency over 5 years, are negative to it. So there's no gain. It's actually a negative to buy US assets from other currencies. But what it also tells you is the US dollar is increasing its strength as a global reserve currency and spending power. Japan is at the opposite end of this spectrum. So the yen is actually weakening against all the other currencies. So good for investors looking at the Japanese market, but harder for Japanese capital to go outside. Same for Europe. It's more attractive to lots of other global currencies. Australian dollar is somewhere in the middle. GBP or sterling is somewhat closer to the US dollar. So quite strong relative to other currencies and destinations. And when we look at global capital sources and flows, we can see that certainly the US dollar or US spending has been increasing in Q1. It has increased relative to its rolling 12-month average. Hong Kong dollar has also increased and improved, as has the Canadian dollar. So we can see these North American currencies quite dominant in terms of their spending power. And I think the dollar potentially will get a lot stronger going forward and more active this year, particularly if spreads in its own market remain challenged. And then finally, if we think about how capital is moving and capital sources, I think what's also interesting is, over time, fundraising for real assets has really dropped off in 2023 and so far year to date in 2024, particularly for real estate, as much as for infrastructure, actually. I think what's also interesting about this investment demand for real assets is now split fairly equally between real estate and infrastructure, which tells you how much of a play infrastructure has from a technology standpoint, from an energy standpoint. But what, as Chris alluded to earlier, despite the numbers being down, what we are starting to see is more requests and more appetite for core funds, for core capital moving in, which to me is a signal that we are hitting bottom and that the market will pick up from here on in. I think the chart on the right shows the number of months to close, and it is now starting to finally flatten out. So again, from a fundraising perspective, it looks like we've hit the bottom of the market and things will start picking up from here. But if it takes typically about 12 months for core funds to get raised, it tells you that, whilst the bottom of the market is here, it's going to be another year before we really start to see the core market coming back. And if you look at the dry powder that is out there, it remains very much in favor of value add, opportunistic and development plays, certainly for the next 6 to 9 months going into next year. So summary for me, we are in a very complex marketplace. It remains complex. The question is, how can investors capitalize? And I'll hand over to Jo now so she can talk through what's happening across APAC.
Thanks, Damien, and thanks everyone for joining. And as Damien said, I'm going to give a bit of a deeper dive into the Asia-Pac region. So I'll just dive straight in on just some of the themes I'll be covering. So following on from Damien's global insights, I'll be looking more at the APAC capital flows and some of the capital sources that are driving investment into our sectors and markets. And then I'll talk a little bit about some of the key themes, particularly around INL or specialised INL, and also a bit around ESG. So just starting up, I'm showing the top sources of capital into APAC. And the grey bar in this chart is showing the last 12 months to March compared to the blue bar, which is the 3-year average. You can see that Japanese capital has increased or seen the greatest increase compared to the 3-year average. And as we saw with some of those, the rates that Japanese capital have benefited from a prolonged low rate environment. And they've also had a strong push into the residential sector, particularly in Australia, and also into the office sector in the UK and US. Now, looking at China, Chinese investors have remained consistently strong in Hong Kong and Singapore, but they're also starting to increase into other markets such as Indonesia and Malaysia, and also a bit further afield now to the UK. And then you can see from the downward shifts, you can see that US capital has started to shift a bit lower, but you can see it's still a dominant capital source in the region. As you heard from Damien, US investors are increasing their cross-border spending overall, but the drop in APAC is more a function of them really identifying value opportunity in some of the other regions. And the same with Canadian capital, is pushed more into the UK and also into the Eurozone. Now, again, following on from Damien's global slide, this is the APAC version of the top 10 cross-border destinations to see where that cross-border capital is landing across the APAC region. So Damien's already highlighted China and Japan are in that global top 10. But for APAC, we have Singapore, Hong Kong, and Australia rounding out those top 5 APAC destinations. Now, for Singapore and Australia, you wouldn't have seen those in the top 10 global. They've actually fallen out of the global top 10 since last year. And again, this is really more a function of capital is really searching within other key markets where we've seen stronger value adjustments to date. It's worth noting Malaysia. Malaysia's really growing in importance with strong interest in particular from investors into the INL market. So it's really seen as a growth INL market, and I'll talk a little bit about that later on. And the same goes for India and New Zealand. They're seeing a lot of investment from INL or into INL from global offshore investors. And then lastly, South Korea. South Korea is still enjoying really strong interest in their office sector. They've still got very low vacancy rates. It's around 2%. And this is really driving some strong rental growth prospects still in the market. Now, just a quick look here at the difference between APAC and global cross-border capital and what sectors that they're gravitating towards. And it's interesting here that you can see that the APAC investors are really dominant within the residential, industrial and retail sectors, and they're all attributing to around 70 to 80% each of their total Q1 volumes. Whereas if you look more to the right of the chart, global capital is gravitating more towards the hotel and office sectors. Now, I've put this slide up because I think it'll be really interesting to see how this progresses through the year. We do expect a greater proportion of global capital in the residential and industrial sectors. We know that there's increased capital allocations globally for these two sectors in particular. Now, I'll just take you into a bit of a deeper dive now of some of the beneficiaries of both APAC cross-border capital and also global. And looking at what markets are really benefiting from APAC cross-border capital to start with. I've excluded China because over 90% of that capital is from Hong Kong. So as I mentioned before, APAC capital remains attracted to both those beds and sheds when investing in the region. And you can see Japan and Hong Kong are both seeing major contributors. So Japan seeing from Hong Kong and Singaporean capital, investing in both industrial and also residential. The same for Hong Kong, it's industrial and residential. And then just worth noting there, South Korea, that's been driven by really the hotel sector. And the hotel sector in South Korea is attracting growth. There's strong growth in tourism in South Korea, particularly from Chinese, Japanese and US tourists. And there's also just worth noting here that there's also been very strong hotel volumes in Australia over Q1. And then now this slide is highlighting the major beneficiaries of global cross-border capital. And as I mentioned before, it's really been the office sector that global capital has been gravitating towards. So 64% of APAC office sector investment was from global cross-border capital. And the APAC region presents really strong underlying office fundamentals compared to the other regions and some strong occupancy rates. Average is about 80% across the region. And there's also pockets of outperformance within some of the markets that even have high vacancy overall. And then just looking a bit of a focus on industrial. And we traditionally think of industrial as traditional distribution centres and warehouses, but the industrial sector is really evolving and it's driven primarily by cold storage assets and also data centre investment. And these sectors are really growing in importance in driving cross-border capital to the region. They're really searching for diversification and growth. So the chart to the left shows the proportion of data centre and cold storage transactions by year as a proportion of total I&L transactions. So as an average over the last 10 years, these specialist sectors have averaged around 15% of total transactions. And this compares to the prior 10 years, which was around 7%. And Q1 is now at the moment at 27%. So I think there's a lot more growth and interest coming from global capital. And then just to the right-hand side, just looking at investment volumes for those two asset classes, APAC is already 78% of the 23 volumes. For data centre investment. So I think it's going to be another strong year for data centre investment. And then just lastly, just looking at ESG, and APAC investors are still on that ESG deployment journey. And APAC is really lagging other regions in the introduction of mandatory reporting. We've really seen in EMEA, mandatory reporting has driven a quicker adoption than what we've seen in APAC. And these are some results from our last Global Investor Outlook survey. And APAC investors noted a stronger response to only considering the environmental performance of their assets and are yet to decide on benchmark strategies to drive ESG. Where if you see EMEA there, they're indicating that their ESG benchmarks and disclosures are already in place. So there's a bit of a way to go to APAC, and they're definitely increasing in their strategies. And also APAC investors are indicating a greater preference to investing in core ESG assets. So I think that there's a lot of opportunity for owners there to upgrade existing assets and attract a greater share of APAC cross-border capital moving forward. And just to wrap that up, and I hope some of these things will be a topic of conversation in the panel, just some of the opportunities here. So as we said, the office asset class is receiving a growing share of office capital allocation, particularly from global offshore capital, and has got some strong rental growth outlook. So there's still opportunity in some key markets. Specialised I&L sectors will continue to grow in dominance. So I&L is definitely becoming a more sophisticated asset class. It's offering greater scale to investors. You saw that Australia and Singapore have dropped out of that top 10 destination, but we do expect a larger pool of capital to return, global capital in particular. So there's a bit of a window of opportunity before the buyer pool has greater depth in those markets. And then also the APAC region gives us access to growth markets, so stronger income profiles and higher returns. And as you saw from Damien, a much stronger GDP and economic profile than we see in other regions. So that's it from me. And as Chris pointed out at the start, we're actually going to make things a little bit interactive with a bit of audience polling. So there's going to be 3 questions, which I'll read out. If everyone could just select their answer, and I will read out the results of the poll. And again, hopefully there's some good sort of things to discuss in the panel, and I'll pass a few of those over. So the first one is your top destination of choice for investments over the next 12 months. So if you could just choose, I'll give you a few seconds. Okay, the next one is your top choice of asset class for investment allocation, and I'll give you a few minutes for that one. And while we're doing that one, I'll just tell you the results of the first one is we're on 45% for Australia and New Zealand. I'm sitting in Australia. I'm not going to be biased on that one, so I'll pose it to the panel. And then we've got Asia at 36%, Europe at around 8%. And then on the asset class, on this question, we're looking at industrial and logistics, the golden sectors, 26%. And the office sector is quite promising at 16%. So the last question is, where do you think we are in the investment cycle? Are we at the bottom? Are we close to the bottom? Are we in a rising cycle? Okay, most of us agree on this one, that we are close to the bottom. And again, it'd be interesting to see what our panel thinks about that in their panel discussion, which I'll now move on to. So I'd like to welcome back Lucy and Thomas, Hazumi, and also Chris to the panel. Thanks, everyone. And we all got our microphones on?
I hope so.
Yeah, great. All right. So I'm just going to start. Don't forget, everyone, you can still pop your questions into the chat, and we'll pick some of those out. But just to get things started, I thought I'd start with you, Hazumi, if you don't mind. Welcome. Okay. There's been a lot of talk, and for good reason. Japanese capital it's definitely been widely discussed over the last 12 months. Investors obviously have had access to rock bottom financing rates, the lowest across developed countries effectively, and it's really underpinned strong buying capacity to purchase assets in markets such as the US, UK and Australia. So I thought that since when we talk about Japanese capital, it seems to be rolled into one collective. Can you talk us through a little bit around the different types of Japanese capital that we're seeing investing overseas, and also their different approaches? Just the second part of that question.
Great. Thank you for your questions. Actually, there are 3 main types of the Japanese capital or Japanese investors. First type is investors. Investors are mainly the financial institution, such as banks, insurance company, and also the pension funds. They can be called like an institutional type of the investors. And those investors do not invest directly in the overseas real estate, but invest in the US-based like a fund, such as Goldman Sachs, Morgan Stanley, and Blackstone. So since they are the investors, they can be said that it can be said they invest in real estate. They invest in real estate as a financial product. So next category is we have developers. So this is usually the company who develop and own the real estate, such as the Mitsubishi Estate and the Mitsui Fudosan. Maybe everybody knows them. So therefore, in many cases, so developer do not wish to be the equity partners, but only to invest in the fund. So they aim to be the the development partners, invest together with local the fund or the developers. So as a developer, they actually take a risk, development risk. So in many cases, I see that they prefer to development project to acquiring the existing property. So they often describe themselves as a developer, not investors.
Okay.
So
Yeah.
thirdly, sorry, one more thing. There are another one I would call investor/developer category. So this category is trading company. I would say like an investment/trading company such as Mitsubishi Corporation and Itochu and Sumitomo Corporations. So these companies are very unique because they have both faces as an investor and developers.
Great. I think that clears a few things up for us, Azumi. Thanks for that. And can I just ask you one more question just quickly? Yep. Damien obviously mentioned the borrowing capacity of Japanese investors, is dropping. But do you still see, how do you see that playing out over the next 12 to 24 months? Do you think there'll be a significant drop in any particular markets?
I think that looking back to the past 12 months, and I believe that developers, not financial investors, financial institution type of the investor, they have been very active still, and in particular, many developers has started investing in Australian market. So I think that we expect more and more of them is coming to the Australian market in the future.
Yeah, well, that's a good segue, Lucy, maybe to you. And on Japanese capital coming into Australia. Australia was actually with the top 5 destination for Japanese capital last year. What asset classes have been the major beneficiary of that Japanese capital?
Yeah, sure. Thanks, Joe. Look, I think to follow on from Hazumi's point, obviously, yes, Japanese capital was very active last year, and that gave us a great opportunity to work very closely with our Japanese colleagues. Now, of course, when we're thinking about the transactions that did go through last year, there were some big headline transactions with 60 Margaret Street. Obviously, that was Ash Morgan purchasing the asset, but that was backed by a number of Japanese capital groups, and that was really spearheaded by Mitsubishi. But we also saw Daiwa House going into 7 Spencer Street, which is, again, more of a development repositioning, which is a development. So as well as seeing Japanese capital enter with, for Lendlease, for example, with the build to rent and also One Circular Quay. We also saw Japanese capital pair up with Mirvac and some of their build to rent projects. So I think that's really speaking to that piece that Hazumi touched on, which is where it's really that emphasis on that development exposure and gaining that experience of development in the Australian market, which I think is really a compelling way for them to gain that current exposure as well as lessons learned that can be applied moving forward.
Yep. Fantastic, great. Thanks for that. And I've just had I did have a question for you, Thomas, but I've had one come through from the audience. So okay. So as we see more investment into the office segment, could we say that Hong Kong would be an outlier as the segment is seeing record high vacancy rates? So would it be accurate to say that while the rest of the region could see an office investment boom, Hong Kong will not be joining the party?
Yeah, thank you for the question. It's a tough question, but yes, look, I think, the office sector in Hong Kong, I don't think it will pick up very quickly. As pointed out correctly in the question, we do suffer from a high vacancy rate, and also there will be more supply coming up in the next few years. We have been seeing, however, a drop in capital value in Grade A offices. Quite a significant drop, actually. If we compare to our peak in 2018 to now, we'll be seeing 40 to 60% drop in capital value. In fact, we just witnessed a transaction of a strata office of a famous building in Central. So that was sold 60% under the value of its peak in 2018. And I think there will be more pressure coming on. But if we're saying that investment activities will pick up for the rest of the region and not Hong Kong, I may disagree with that, because although the office sector may be slowing down and continue to be slow, I think, for the coming years, I think there are lots of other opportunities in Hong Kong, right? Especially in retail, in the accommodation sector, especially talent accommodation, student accommodation, and hotel. That poses, great opportunities, especially now that when the borders are opened and capital value have come down, we are seeing more capital coming in, especially from even from Singapore, from Malaysia, from China, looking for these type of opportunities.
Great. Thank you for that, Thomas. I've just had a question come through around construction cost escalation, and I thought, Damien, I might just bring you in here and just maybe set the scene a bit, just across Europe. Well, how has construction cost escalation affected the markets across Europe? Is there a pullback in supply? How is that playing out? How is that affecting the market?
Good question. Lovely one.
Sorry.
See, yeah, but it is, right? So,
yeah,
I mean, if we look at the pipelines for all commercial real estate, the pipeline is doing that. So in a year, the level of new supply coming through is minimal. And I think in many respects that will just bolster values. It's going to bolster rental growth. But also, I mean, I guess there's different narratives around how much should we be building anyway, rather than retrofitting, with the whole ESG agenda pushing more towards that. But yeah, the pipeline per se is dropping, and a lot of it is down to the cost of construction, and also just weakness in the economy, not necessarily feeding through into take up. But we are seeing take up bottom out in offices in Europe, and it's starting to pick up slightly in industrial. So, but yeah, I think it will limit choice, but it's going to bolster values.
Yeah, definitely. I think we've seen the same the same trend across the APAC, and the pullback in supply. And I think it's only going to help some of those markets with higher vacancy, and particularly for APAC, where we're seeing strong population growth and that lack of supply, particularly for the higher grade supply. I think, as you said, it's just going to drive rental growth and values. Thank you for that, Damien. I'm just going to pivot to Chris. Just a bit more of a APAC overview, Chris. There's a lot of talk around, I suppose, newer segments or emerging segments across the APAC region. Could you just give us a bit of your thoughts around what are the markets and asset classes that are gathering some of that investment momentum?
Yeah, no, thanks, Julie. I think it's actually a really great question. And I think when you look at some of those stats we've discussed today, particularly within Asia Pacific, having probably a stronger office sector than perhaps our counterparts in the US and EMEA. But of course, there is still huge asset class diversification happening. And when we're talking to clients, particularly in this region, I'd say besides obviously pivoting, as you've touched on with logistics, but even that as a sector has become far more nuanced. And when we're speaking to investors, it's not just buying a shed. It's I'd like to look at last mile logistics, cold storage, data centers falls into that. But I think that diversity of asset class, even within subsectors, is becoming far more great with the capital that we're speaking to. And I think, again, as we saw on some of those stats, particularly around the residential sector, while some of the markets in Asia Pacific have nuances in terms of the living space generally, the actual capital in the region is very keen on looking at the multifamily sectors. So we see that built to rent or multifamily market, particularly with capital from Singapore, Hong Kong, looking to go into Japan and into Australia as well. And I think, just pivoting back to that point Damien touched on around construction costs, the biggest challenge around that particular sector or any of those living or operational type asset classes is we still see there's far more capital wanting the end product relative to actually the product availability and not necessarily wanting that development risk, particularly when it comes down to construction cost or delivery as well. So there's variances in terms of what the capital would like to do relative to what those opportunities are. Yeah. And then again, I'd say some of those strategies, again, we see pivoting, far beyond Asia Pacific as well into some of those deeper markets. But certainly living sector is still very strong. And of course, as we saw even from our own poll, INL still probably the top pick. So.
Yep. Fantastic. Thank you for that. I've just had a question come in for Hazumi. Question to you, is there still room for new investors to buy Japanese assets? So in short, is Japan likely to attract more cross-border capital?
Okay. Actually, that I am outbound guy, so that I'm not actually that expert for the inbound. Actually, that the Japanese market. So
I'll put maybe Chris. Chris, do you have an opinion on Japan?
Sorry, Joe, I lost that one, but
That's okay. That's okay. We're just putting from Hazumi because it's more about inbound capital to Japan. But is there still room for new investors to buy Japanese assets? So basically, Japan likely to attract more cross-border capital.
yeah, look, I mean, and again, just within the region, I mean, we're seeing far more capital looking at Japan. It's probably still one of the most dominant markets that we still get asked about. And I think that's largely just diversity of sectors as well. You know, Japan's a really mature market. There's a very strong office asset class already well established. Of course, it's probably the most established multifamily market within Asia Pacific as well. And I think, you know, not only with capital in the region looking at Japan, perhaps some of those US funds that we see also domiciled in APAC for their regional strategies, of course, taking advantage of currency as well. So, I mean, from that perspective, you know, we see Japan continues to probably to be that market of choice in terms of where the spreads are looking stronger. There's diversity of asset class, but also depth of market as well. So in that respect, yeah, Japan's still absolutely number one for capital.
Thank you.
Yep. Thanks. Sorry, Hazumi. Damien, this one might come to you here, and we just sort of talked about apart from Japan and maybe a little bit in South Korea, UK capital has pretty much stayed close to home, investing across Europe. Do you expect there to be a bigger shift to the APAC region over the next 12 to 24 months maybe, and any particular markets and sectors?
That's a tough one. I mean, I think generally UK-based investors will continue to invest in the region for the diversification of benefits that we've spoken about. I mean, I think they've pumped about 20 billion into APAC in the last 9 or so years. Obviously, it's dropped off as the whole cycle has dropped off. But I mean, again, interesting when you look at who the bigger players are and what they've invested in. Almost half of that has gone into offices as well, which tells you that, I mean, it's the strength of the office sector in APAC, and that relative to what's available in Europe is a diversifier. So, and equally, you know, it's the push-pull factors. So because the UK is such a magnet for global capital, it makes it very competitive. So equally, some of that UK capital needs to find somewhere else where it can get better returns and different returns and get a more sort of diversified return profile going. So I think they will continue to invest, you know, and there are some big players that are in APAC, and they're certainly not going away. I think they'll continue to expand. Japan, Australia will probably be the top 2 markets because, again, they're the most established markets with plentiful assets across sectors.
Definitely for office. Actually, just while you're talking about Australia, I'm going to flick back to you, Lucy, but just take a bit of a different lens and talk about potential outbound Australian capital. So we always talk about investment into Australia, but I think the potential for growth in outbound Australian capital is quite an interesting topic. Do you see a possibility in the near future that there will be a particular driver for outbound capital, and what types of capital do you expect to see?
Yeah, thanks, Joe. That's a great question. I think, look, I think at the moment, I don't think Australia's even cracked the top 20 in terms of outbound capital sources. I think, happy for you to correct me, I think we're number 21 at the moment, but it is an interesting piece. Obviously, we've seen some of those headlines around Australian super looking to expand operations overseas, and we're seeing that some of that enacted. And that makes sense. You know, if you think holistically, there's been a lot of merger and acquisitions in the Australian super fund space, where we're seeing major super funds sort of group together. And so again, logically, as part of that diversification piece, it makes sense that they would have some of that exposure to offshore real estate. Now, that is still a relatively small portion of their overall holdings, but of course, yes, within that, we have seen, you know, Aware Super have set up their London office with a commitment to spend $3.5 billion offshore, targeting European investments. We've seen Rest Super as well recently contribute $150 million US into the Fidelity Euro Net Zero Fund, targeting those net zero industrial assets. And of course, we've seen Australian Super commit to spending $8 billion in the UK over the next 10 years. So that has been a really interesting thematic. And I think that's really quite reflective as well on the market more broadly, where we have seen that sort of more rapid price adjustment occur throughout the UK and offshore, which is making that offshore piece for Australian super funds really compelling. I do think, it's worth keeping in mind that I think Australian super funds will continue to be active offshore, but as we're seeing some of that repricing roll through in Australia as well, we're seeing them continue to be active domestically. We've seen some major investments from Aware Super, particularly active back at home in Australia, and also we're seeing them as some of the most active buyers in that industrial and build to rent space. So I think as that Australian pricing starts to roll through, we'll continue to see super funds and global capital back re-entering Australia. But yes, it is going to be a really interesting thematic over the next few years, seeing that offshore Australian capital piece build out.
Maybe we won't get to top 10, but maybe if Damien does a top 15, we might squeeze into that. So there's one to note, Damien.
See what I can do.
See what you can do.
If I just shuffle the tables a bit skinnier to get Australia on.
Yeah. Chris, I'm going to pivot back to you now and throw this one to you. There's a few questions just around sort of investors' perception of some particular markets. So I'll start with these, Vietnam and Philippines. So what's I suppose a perception around those as a destination for investment, and any particular sectors as well?
Yeah, Joe, I think within Southeast Asia, I think all the markets are generally emerging rapidly, and particularly I think whether it's the Philippines or Vietnam, based on an office side, we're obviously seeing far more back office space being set up there. The logistics markets continue to grow, and of course, just from a pure end of use residential market, those are still massively growing in some of those cities. So we see those as key growth markets. In terms of that broader, wider capital, I think there's less perhaps from the region or even globally going into those markets specifically, unless it's perhaps some of those really big funds who have more diverse approach, both in terms of development markets, but also developing markets in terms of where they can seek higher return as well, but obviously higher up the risk adjusted curve as well. So for sure we are seeing that, but particularly in all those different asset classes, data centers, logistics, office, there's certainly growth and opportunity in that.
Yeah, and then just the next one is India. The question is around what global regions are actually talking about investing into India and what sectors. So I think INL and data centers is probably there, but what's your take on that?
Yeah, look, I mean, I think India's had for over 10 years now a really strong international capital attraction. And I think that theme is still pretty much on trend. And I think we see that largely capital from North America. And I'd probably quantify that even further, that the Canadian pension funds in particular have really driven that investment into Canada. And perhaps they, even prior to when India was perhaps a bigger market than we see today, but certainly from the office space, we've seen a lot of Canadian pension fund capital. And as you rightly say, that has pivoted to industrial investment as well. The other sort of, again, bigger region, I think, which naturally lends itself to India is still Asia Pacific. And again, I think less so from perhaps private or propco type investors, but particularly from the bigger institutions, whether pension funds or sovereign wealth. We've certainly seen, particularly from Singapore, a really strong driver of capital into the Indian markets. And again, office and logistics. But I think increasingly we're getting asked by our investor base, how can they access India? And often that's through partnership or coming into land development deals as well. And I think as we saw from your research as well, India as a land market is still a huge opportunity.
Yeah, definitely within that top 10 for global. So there was a lot of strong APAC markets in that land piece. We've had a chat just around industrial. Thomas, I'm just going to bring you back in and talk about industrial in particular. So Hong Kong investors have sort of taken a different approach to asset classes so far this year. So last year there was a strong residential push. This year it seems to be industrial. Is this something that you're seeing within Hong Kong as well? So are local Hong Kong investors investing in industrial, and you expect that to stay for the next 12 to 24 months?
Thank you for the question. Actually, the industrial investment market has actually slowed down quite a lot. since after,
Okay.
especially since the border opened. Just some rough numbers. During COVID in 2021, we saw about 30 billion Hong Kong dollars worth of industrial asset transactions. Last year, we are like 1/8 of that, only
Okay.
4 billion. And this year to date, 135 million. So not even reaching 1 billion. So as you can see, investors after COVID, they tend to move away from industrial because the yield spread and the cost of capital is just not there, and the pricing adjustment is not enough for them to deploy capital. Instead, they are moving on to other type of distressed asset which they can see a stronger rebound, like retail, like some strata offices, right, like hotels and build to rent, etc.
Yeah, great. Thank you for that. I'm just going to throw now to maybe Damien, just around ESG. We hear probably ESG, apart from talking about interest rates or getting questions about interest rates, probably ESG is the next one I get many questions on. And everyone's talking about ESG being a big opportunity for investment, particularly this year. UK and Europe are definitely much further along in that ESG journey. What do you think are some of the maybe findings or key takeaways and learnings that we can take from how ESG has been embedded into real estate and investment decisions in EMEA? So any key takeaways as a region that we could think through?
There's a few. I'll try to kind of simplify it. I mean, it's very complex, right? So, and I think in many respects, the regulations around it are too complex. And whilst the ambitions are correct and noble in terms of decarbonising, I think it's difficult for the whole investor landscape and occupier landscape to get to grips with it. And I think what you also see is it's only the big players that have really adjusted and understood what they need to do and what their plans are going forwards in terms of capex and spending and disposals, etc. Whereas for the smaller and mid caps, they just don't have the resources to figure it all out. So they're kind of behind the curve, and that seems a little bit punitive on them when, ideally they're all still trying to do the same thing. But I mean, that's the kind of regulation side. I think the key thing is, for success, it's about working in partnership with occupiers, because it's all about understanding use of assets, how energy is used, and optimizing that, and also optimizing the building for their use in terms of just general fit out and the kind of social well-being of the building. But I think the key thing is clearly around energy and decarbonizing energy. And for the successful investors, it's how you go about doing that, how you fund it, how you bring it forward, how you try and, where you can, rentalize energy, which is available in certain asset types, and also how you change your capital structure to be more cost effective. So bringing in green bonds and using more green bonds to pay for a lot of the capex and reducing your overall cost of capital. And it also reduces your cost of debt when you have far better, more sustainable, energy efficient buildings. So, but working with your occupiers to do it and understanding that energy use is a key part of that whole kind of partnership approach, really.
Yeah, fantastic. But so, it's definitely going to be a growing part of the conversation, and I'm sure we'll be talking about it in other webinars. I might just wrap it up there, but just before I do, 10 seconds, I'll go through each of the panel members, and I'd like to know what your top opportunity is for 2024 within the region or maybe outside the region, up to you. So Lucy, can we start with you, please?
Australian. Look,
just Australia. That's it. Australia.
Just Australia. Full stop. Look, I still think in 10 seconds. I still think the shed piece is very compelling in Australia. We're looking at vacancy rate, sub 1%, resi sub 1%. But then I think there could be some sleeper opportunities in obviously in the retail sector, which has already been through a bit of a reset, and there's some upside there on rents. And then office, of course, again, I think we're going to see, obviously, some transactions have gone through recently that I think will set the market benchmarks. sales come through in June, and I think that's going to be some really compelling buying opportunities for the back half of the year. So I kind of cheated and said 4.
Yep, that was more than 10 seconds. So Hazumina, you now have 5 seconds.
Sorry.
All right. Definitely Australia. I should say Japan, but Australia.
There you go.
As an outbound guy.
I'll slightly cheat Joe with my global hat, but I think capital as a source will remain dominant from Asia Pacific. And I think from most of the investors we're talking to in this part of the world, 3 markets they want to be in is the UK, Japan, and Australia. And sector-wise, it's still dominantly logistics and residential.
Yep. Thomas?
Yes. Well, with the government's continued big initiatives to attract more talents into Hong Kong. So, we are seeing the population growth quite fast, and international students as well, talents. So I think student accommodation, hotels, switching into co-living, retails, discounted retail with a higher cap rate, that's going to be the pick for this year.
Yep. Okay. Damien, one word. You've got 1 second.
One word? That's too hard. European hotels.
Australia.
But...
There you go. So Lucy took all your time, sorry.
Sorry,
so I just want to thank the whole panel for your time and also your insights. It's been a great discussion, and I'm just going to hand over to Chris for some closing remarks.
Jay, thanks very much. It was a really, really great panel, so thank you for that. Just as we close today's session, you're going to see on your screen very shortly that there are 3 very short survey questions which are confidential, and we'd really welcome your feedback. Whilst you're looking through these, we very much hope you've enjoyed today's session. Please do reach out if you have any further questions, or there are any specific experts you'd like to connect with, or where Colliers can help you. A recording of this webinar, as well as this exclusive research, will be circulated to you after this event. Thank you all for your participation, and we look forward to seeing you at our next Colliers Global Capital Markets webinar. Thanks very much.